All right, hello everybody. I am Dr. Richard Smith here for the 80th anniversary celebration. We're having a full week of seminars on, we had a Science Cycle Summit on Saturday, and this week our Financial Cycles Summit. And we could not be more excited to be kicking it off with the one and only Robert Prechter, a man who needs little introduction to this audience. Someone who's been working in the financial space and the psychology of finance space for literally decades. Started the Elliott Wave theorist back in, I think, 1979, was it, Bob?
Yes, 79.
And founder of Elliott Wave International, as well as the Socionomics Institute. So, Bob, we are thrilled to have you kick off our 80th anniversary week. We are very honored that you would spend some time with us. And, you know, I don't want to get in the way too much. So if it's okay with you, I'd love for you to just jump into your presentation. And then we can talk a little bit after everybody's seen what you have to share.
That sounds good. Let's go ahead.
All right, great. So we're going to turn off our videos. You're going to share your screen, and we'll take it away.
All right. First of all, I want to say thanks to Richard for revitalizing the foundation. Near the end of an extended bull market right now, so cycles are about as out of fashion as they can get. I believe that's going to change. But anyway, we've got a small group watching us today, and for those of you who do like cycles, I'm going to mention those a little bit as well as waves.
My title is Regime Change because I think we are about to see some decade-long trends shift direction. I think it's going to happen in the stock market, the commodities market, interest rates, and the economy. I'll make my case. You can take it or leave it. We're going to start with the stock market, but before I do that, I'm going to spend just about 30 seconds reviewing the Fibonacci sequence because you're going to see a chart with numbers on it, and if you haven't been introduced to this before, you might wonder what they are. The Fibonacci sequence shows up throughout living things in nature, plants, animals, and so forth. You can look it up and study it if you like. And I think it is also a factor involved in growth systems, and that includes human societies, which are large growth systems, growth and decay systems. The sequence itself is created by adding two numbers to get the next. So if you add 1 and 1, you get 2, 1 and 2, you get 3, 2 and 3, you get 5, and so on. Take a look at these numbers if you haven't seen them before, because the next chart's going to have all of them on it, all the way up through 34, 55, 89, 144, and 233. It so happens that the further toward the right you go, the closer the ratio between adjacent numbers becomes 0.618. And the inverse of that is 1.618. It's the only number that does that is 1 plus its inverse. So now we're going to look at a 200 plus year chart of US stock prices. It so happens that the data for this is the Dow Industrial Average going back to the 1880s. But prior to that, it's data from different indexes that newspapers and other sources kept back in the 1800s. And that data was originally gathered by none other than the Foundation for the Study of Cycles. So we've had this data for a long time and found it very useful for Elliott waves. We're not going to count Elliott waves on this chart, but I do want to show you some really interesting time sequences here. If you look to the bottom left, you'll see over here that in 1788, the US Constitution was ratified. In other words, that was the formation of the country. It's 233 years, which is a Fibonacci number of years, from that year until 2021. Now, that really doesn't mean very much to me, and wouldn't, except that we find it's really the largest number involved in a whole web of Fibonacci numbers relating to the turning points in the US stock market from its founding. So let's look at the left side of the chart first, and you'll see that the first 144-year period ended in 1932 at that major low, the low that occurred 1 year before the Great Depression bottomed out. You'll notice that it was subdivided into also two Fibonacci numbers, which we call a Fibonacci section, so that from the founding until 1842, which was the stock low just before that depression bottom of 1843, lasted just under 55 years. And the move from there until the 1932 low to the next major bottom was just 1 year more than 89 years. So you had 54 years on the left side, 90 years on the right, approximately dividing it again into a Fibonacci section. But what's really gotten interesting is what's happened since 1932. So if you'll look toward the upper right area of the chart, not the very top, but toward the right, you'll see that there are major turns in the stock market here in 1932, in 1966, 1987, and 2000. And you'll see that 1966 is a Fibonacci 55 years from guess when? 2021. The 1987 high crash is 34 years prior to 2021. And the very major top of 2000 is 21 years prior to 2021. So you've got a declining sequence going on here. The ideal turning year would have been 2008 to give you 13 years until 2021. We had a high in 07 and a low in 09, kind of spreading the difference. And then they go down to 2016, which happened to be the wave 2 low, intermediate 2 of the entire bull market from 2009. We've had a high in 2018, which was 3 years before 2021. That was a peak. And then in 2020, we had a high and a low and a crash in between. So that's 1 year. The entire sequence goes down from 89 years from 1932, 55 years from 1966, 34, 21, 13, 5, 3, and 1. You can see that it skips 8 because that was that one that was kind of a compromise, and it skips the 2. But for the most part, the sequence is intact. And if you look here at the top of the chart, you can see that those very same turning years in the market give you a declining sequence from 34 years all the way down to 1. It's the sequence backwards, and it happens to culminate in 2021. All these numbers are the same year. So it's in effect a Fibonacci spiral that's zeroing in on a target year of 2021, and we're there. So what would happen? Is it going to be a major turn of some kind? Well, counting the Elliott waves all the way from the bottom in 1784 in British stock prices through last year's high and low, I think we're coming to the end of the entire 5-wave sequence in 2021. And we're also seeing it in terms of these time ratios and Fibonacci time sequences. And I think we're also seeing it in sentiment indicators. I'm sure a lot of you are stock market followers and watch sentiment indicators. My colleagues, Steve Hochberg and Pete Kendall, have been showing, I think, up to 50 or 60 sentiment indicators in the last year and a half that are reaching all-time extremes, bigger than anything in 1929, bigger than anything in 99, 2000, certainly bigger than anything in 2007. The amount of speculation going on is truly off the charts if you didn't have a higher end on the old charts you were using. We've had to extend the tops on all of these just to plot them. So the extremity of optimism in the financial markets, I think, fits the idea that we're culminating a great, great bull market that's 233 years in length, or maybe a little bit longer if you're using British stock prices. Well, if we're going to make a major top in 2007, what should happen thereafter? Well, the last time we made a top of this degree was the year 1720 in Great Britain at the top of the South Sea bubble. Now, it so happens that the entire collapse, the first crash off the South Sea bubble high, took only 2 years, from 1720 to 1722. And there's a reason why I think we could be set up for the same type of crash now. And now we're going to turn to look at some cycles. I have been following cycles for a long time, but most of them that I've followed from 2 weeks to 4 years have tended to disappear over time. So it's very possible that these will as well. But to me, the two strongest cycles, the ones that have remained the most reliable and the most intact for an entire century, are the 20-year and the 40-year cycles. You can see that the 20-year cycle started in 1903 on a major stock bottom. There was another one in 1921, another one in 1942, a crash into a bottom in 1962, another big low in 1982. It doesn't show up in the Dow on the upper chart quite as well as it does when you adjust for the PPI. And you can see that in real terms, that was a really major bottom, just like the one in 1942. And then again in 2002, and the next one is due in 2022, and that's also the 40-year cycle. If those cycles are due to bottom in just 2 short years, I don't see how we could possibly get from an all-time high at a grand supercycle peak to a low of the 20 and 40-year cycles without an extremely strong decline. Something akin to a crash and something much bigger than we've seen at least since 1929, 1932. Now, as I said, this cycle may not hold. If it doesn't hold, we're just going to go into the bear market in some other type of manner, and it's probably going to last a long time. From the South Sea bubble high in 1720, British stock prices entered a bear market that lasted 64 years. That's a long time. But in Elliott Wave terms, that was a zigzag pattern, a down, up, down, without a new high in the process. It's a simple correction. Under Elliott Wave theory, the fourth wave, which is related to the second wave, is usually a more complex correction, such as a flat or a triangle pattern. Those tend to last longer than zigzags. So if we're making a grand supercycle top here in 2021, I think it's going to lead to probably 100 years of the type of bear market we saw from 1966 to 82. You see this big sideways period here? I think that's what we're facing looking out about 100 years. So this one-way bull market that's been going on since 1932, I think is ending in 2021. It may even be ending it from a much longer time back. All right, if the stock market is about to enter its own regime change, possibly doing something completely different from what we have seen during the entire past 233 years, are there any other markets that ought to be shifting? Well, I think there are. And the first one I'm going to talk about from here is the commodity market. Now, this market that I'm going to show you is going to be labeled with Elliott waves throughout. We haven't seen those yet, so I'm going to give you another 30-second primer, as we did on the Fibonacci numbers, this time on the Elliott wave model. The Elliott wave model, in one sense, is very simple. It says the market prices subdivide into 5 waves when they are going in the direction of the one larger trend. And they subdivide into 3 waves when they're going against the one larger trend. When you iterate that idea, you get this kind of picture. You can see that all the bull market moves are 5 waves when they're going in a larger bull market. And then even declining waves can be 5, like this one right here. But it's in 5 waves because it's in the direction of the larger trend. And then the counter trend move in a bear market is 3. So that's how you have to look at Elliott waves. It's not always 5 up and 3 down. It's 5 in the direction of the larger trend and 3 against it. Now, if you look at these numbers, you'll see that they are telling you the number of waves in each of the patterns. For example, this 1 here corresponds to this Roman one at the top. And this 1 here corresponds to the 1 wave in the bear market, labeled Roman 2. And see this 5? That relates to these circled waves called primary waves. When you look at all of them, starting in the corrective side, you can go 1, 1, 2, 3, 5, and so on, and you find that the model is recreating the Fibonacci sequence. So that's where it comes from. So the first chart I'm going to show you is the first commodity chart I ever published. This was back in February 1981. Commodity prices had peaked the previous November 1980. So I showed this chart and I said, look, this is a very big bull market. I think commodities are going to enter a bear market that's going to last a long time. And you can see at the top here what my headline was. It said, end of an era. The 13-year rise in commodities may be drawing to a close. And it did, because for the next 2 decades, commodity prices went down. And what I'm going to show you on the next chart is where this bull market fits into an even longer period of time, nearly 100 years in commodity prices. So here we see commodity prices back to 1933. All right. Now this portion right here, if you can see the cursor I'm using, is the bull market we just looked at. It had a very small first and second wave, 3, 4, 5. It ended in November 1980. And this is the bear market that followed. So it was the end of an era, but even these waves fit into a much larger Elliott wave sequence starting in 1933. You can see that there was a first wave up and it's subdivided into 5 waves. There are 3 waves for this Roman wave 2. There are 5 waves up into Roman wave 3. There are 2 sets of 3 waves down to end Roman 4, and then 5 waves up into 2008. That ended the larger Elliott wave sequence, just like we saw in that model. Well, what happens after you get 5 waves up? Well, the same thing that always happens. You get 3 waves down. But in this case, they're even bigger because the bull market that ended is bigger. So we had the A wave down, a B wave up, and 5 waves down in wave C. I'm going to show you some details of this, but before I do, I want to orient you to the fact that this is not just a retrospective analysis. We had called virtually every turn in oil, for example, which is the largest component of the CRB index, which is what we're looking at here, from the late 90s all the way into 2020. So I'm going to show you some of those details in those real-time charts that we publish, so you'll get an idea of how useful this Elliott Wave model is, and also it's going to bring you up to date to where we are today. So the first thing I'm going to do is show you the bull market in oil from this point here, this low in the late 90s, all the way up into nearly the high in 2008. And this is a chart that I published in June of 2008. You can see it's got a clear 5 waves. You got these primary waves, 1, 2, 3, 4, and 5. And in commodities, as we showed, I think it was chapter 7, 6 or 7 in our Elliott Wave Principle book back in 1978, the 5th wave in a commodity market is usually the longest. And by the way, I always chart commodities on arithmetic scale, where I'm going to show you a couple of examples on log scale just for a different perspective. But I think if you're going to chart Elliott waves, you have to use arithmetic scale in order to see them correctly. For one thing, you see this 4th wave here? You can tell it's the same size as wave 2 here on arithmetic scale. If you were to plot that on log scale, you wouldn't notice it. A lot of people were miscounting this wave and trying to count this whole thing as an extended third. And I said, no, man, this is the 5th wave. So I published this. It said a spike top is due. And I gave a range of 160 to 189, which it didn't quite make, but it certainly did give us a nice spike top. Now you'll notice here that I put a note on the bottom right. That was a 78% decline. It happened in only 5 months. You're going to see that number 78% one more time before we're done here. But after that low, you notice it was labeled wave A. What does that mean? Well, it means a rally is due for wave B. It's not going to carry to a new high because it's within the bear market. And that's exactly what we got. From late 2008, early 2009, the market rallied. This is more of a close-up. You can see wave A in the CRB index, wave A in the oil market as well. And it took its time going up. It was a long rally. And here in May 2011, I said, look, I think wave B is over. That's a 62% retracement. That's a Fibonacci retracement. They happen pretty often. And also took this beautiful 3-wave structure. You see a circle wave A, a circle B, and a circle C. Wave B's, it's a counter trend move, right? So you're looking for 3 waves, not 5. And it looked like we had it. In fact, we did have it, because that was right here at this B wave top. The little circle A was here, the circle B was there, and circle C was here. Now this is another chart we published 7 years later. After wave B was over, commodities started to fall again. They went down, they tried to bounce, then they collapsed. They started to rally again, and people were saying, okay, that commodity crash is over. And the reason I published this chart was to say, no, it's not over, because we need a 5th wave down. And we got it. And what I'm going to show you now is a close-up of this bear market from the peak of wave 5 to the low of wave C. This is where it was when we published that chart in May 2018 saying we need one more decline. It held up and kind of went sideways and finally had its last collapse into April of 2020. Now look at this beautiful structure. You've got your crash for wave A, which is typical in zigzags. You've got your 62% retracement, which is Fibonacci. And we were there at the high and we were there at this high. And then you had a decline for wave 1, a correction upward for wave 2, the biggest decline, which is usually the case in wave 3, a sideways triangle formation for wave 4, and then what Elliott called a thrust, which is a short, sharp move, which usually occurs right after a triangle. Now, I told you you'd see that 78% again, and look at this note here at the bottom. The entire decline in the CRB index from the 2008 high to the 2020 low erased 78.6% of the peak value of the index. That's the square root of 0.618. And those kind of declines happen from time to time. And when they do, you can bet that the low is in. Now I'm going to try to back off for just a moment and discuss a little bit of market philosophy. For a long period of time, I have been of the opinion that commodities would do what they did in the past, and they still might. We're going to talk about that in a minute. By that, I mean they usually don't bottom until the stock market bottoms and a depression is over, anytime a depression scenario is in force. And one example was in 1842, the stock market made a big low, and commodities in the economy bottomed in 1843, the following year. That was the first big depression that occurred in the US after the formation of the country. The next big depression, of course, was the 30s. The stock market bottomed in 1932, and commodities in the economy bottomed the following year, 1933. So if we're going to get a stock market crash, how could it be that commodities are making a bottom? I'm not completely sure, but I'm going to go through a couple of perspectives and show you my thinking about this. This is even more history. This is 270 years of commodity prices. The most interesting thing that this chart shows is that during the real money era, when gold was money, cycles dominated the commodity markets. You can see that they were mostly extremely cheap, except in times of war, and they would cycle into higher prices in every time there was a war: Revolutionary War, the War of 1812, the Civil War, World War I. In each of those times, commodity prices went way up, and then they settled back down again, because these were commodity price relationships to gold, which is a sort of commodity itself. There was no reason for them to be going to the moon or crashing to zero. Well, what happened in January 1934? That was the year that President Roosevelt outlawed the use of gold for contracts, for savings, and for computing your taxes. He said, from now on, we're going to use the Federal Reserve's accounting unit to keep track of our money. So I think that is a big reason why 1933 is the last year of the cyclic period of commodity price fluctuation. From that point forward, we have been in an Elliott Wave regime, not a cycle regime. So from 1933 all the way up to this 2008 high, we had a great bull market in terms of Federal Reserve accounting units, and we've had a great bear market that probably bottomed in April 2020. Notice that it brought us back to the price area of commodities for the previous 200 years. To me, that means that in terms of the Fed's accounting units, what people call dollars today, the commodities were unbelievably cheap last year at that low. Now let's look at the bottom at another cycle. There are too few cycles to say this is real, but I did notice that from the 1750 low prices to the 1843 low prices to 1933's low prices was approximately 90 years each time. The first one here is 93 years. It's 90 years to 1933. So I was projecting about 90 years again into a low of 2023. So remember, we looked at the cycles projecting a stock market low in 2022, and I've been saying all along, so I'm looking for commodities to bottom in 2023, along with the depression. Everything made sense, at least up until this Elliott Wave seems to have bottomed last year. So I've got a choice. Do we have an Elliott Wave low, major bottom, or are we going to wait for a cycle bottom about 2 years from now? I'm not sure, but I can show you a couple of different perspectives. This is the one that says the Elliott Wave regime is still in charge. The entire bull market that ended in 2008 was itself an even larger wave 1, and the low of last year is a very large wave 2. If that is true, then commodities are going to go to the moon in a third wave to prices that are hardly imaginable right now. And you can see on that basis, I will have said, okay, maybe this 90-year cycle shrank by 3 years. It's only 87 years, bottomed in 2020. It was 3 years long in the first iteration. Maybe it's 3 years short in the second iteration. But before we jump to any conclusions about this, I want to show you the vision I had previously, which was commodities are going to go down into 2023. If we put the same history of commodities on log scale, you can see it a little bit different perspective. You see this whole cyclic period in the 1700s and 1800s into 1933 is followed by an Elliott wave that looks a little less extreme than it did when you show it on arithmetic scale. And the vision I've had is, okay, here's your 90-year cycle. We're going to have a 2023 low, and that'll be 1 year after the 2022 low in the stock market if the 20-year and 40-year cycles are going to dominate and lead to a collapse. So that vision gives you what I would call a deflationary black hole, where commodity prices actually get back to the levels they were in the 17 and 1800s in dollar terms, which would be kind of an amazing event. To me, the only way that can happen is if the entire credit structure that's supporting bonds, notes, bills, and every other kind of debt that's denominated in dollars begins to implode and collapse, and people can't pay and they default. If all of that happens and if a lot of this credit-based money disappears, then we're going to go into this deflationary black hole. All right, so we've just talked about one possibility, which is kind of runaway prices, and another one is declining prices. Is there a way to reconcile these two ideas? Well, I think there is, and I'm going to show you how I think it can be done. This chart shows you the result of concluding that the Elliott wave pattern is over. It did end in April 2020. That's the decline from 2008 to 2020. It was a clear ABC move, A down, B up, 5 waves down in wave C. But if the cycle is going to work and commodities are going to bottom in 2023, it's possible we could have an immediate run up in commodities that's very extreme. It lasts maybe a year and a half to 2 years, carrying commodity prices back to or above the highs of 2008, and that run up would be followed by a 5-wave decline. The entire picture is called a flat. So you can see my headline down there says a developing flat correction. Now in flats, it's the C wave that tends to be the crash, not the A wave. In zigzags, as we saw in the first decline down from 2008 here, we had a crash in the A wave because B didn't go to a new high. It's called a zigzag, this entire decline. But if starting from 2008, we're actually going to have a flat correction, the bigger crash is going to be in wave C at the end. If all that happens in a brief 3 years, it's possible that we could have a run up in commodities and then a crash, all bottoming in tune with the cycle. But as I said before, it's possible that these cycles aren't there anymore. And if so, this picture could still happen, but it won't happen in that short of a time. It could take 15 years, 20 years, who knows? Because in Elliott waves, in the Elliott wave model, time and price per se are irrelevant. The only thing that matters is form and the relationships between the waves or among the waves. So I think this reconciles the cycles and the waves, the current outlook we have. Whether it happens, I don't know. From a practical standpoint, what do? To me, it's obvious. The low we had last year is absolutely key. We've got two scenarios that say prices are going up from here. One of them is shown right here in this picture. The other one we showed back in the hyperinflationary type of interpretation where the 2008 high was wave 1 and the 2020 low is wave 2. And we're headed to the moon. So either way, short term, prices ought to be headed higher unless that 2020 low is taken out. If that low is taken out, it's no longer a beautiful Elliott wave. If prices fall under here, it's going to be a whole new structure that we're going to have to relabel. And that's going to take us into this deflationary black hole. So just keep an eye on that one level. None of these levels were crucial, but this one is. All right. So I want to show one last chart. I said I wanted to look at stock prices, commodity prices, and one other area, which is interest rates. Now, I'm very confident about the stock market, not as much on commodities as we just saw, but I'm equally confident about interest rates. And here's why. Interest rates rose from 1942, in the middle of World War II, when the T-notes yielded only 2%, all the way up to 1981, when they yielded almost 16%. 39 years of rising rates. Now, they went into a decline from that point, and it lasted 39 years to a bottom, I believe, in 2020. Many areas of the world and many different instruments had negative rates in the years leading up to 2020 and into 2020. I think that is an amazing thing. I don't think it'll ever happen again in world history. Well, I can't say never, but it'll be a long time. That's an extreme event. So I think interest rates are on the rise. Extremely highly rising interest rates can happen for one of two reasons. One, defaults, as we said before, and two, hyperinflation. I think interest rates are going up no matter what commodities do. If commodities are going to go to the moon, then rates are going up because of inflationary influences. If we get defaults and rates rise, commodity prices could actually go down at the same time that interest rates are going up. And interest rates are going to be the black hole that sucks all the investment money out of all the other areas, including commodities. It could be an extreme crisis, a monetary crisis, in which case people are going to have trouble even finding money to buy the commodities they need to live on. So things aren't going to happen overnight. It's going to be a very slow change. If we've got a regime change coming up after 233 years of a very viable United States, is there anything else that could be shifting in regime change as well? I think so. The United States started as a republic, which was dedicated to defending and upholding individual rights. If there's a political change in 2021, I think it's likely to be a regime change from what the republic was prior to this year. And it'll probably take the shape of a shift away from a republic, guaranteeing individual rights, toward a democracy that is leading to more and more socialistic programs. Instead of ones that benefit individuals, there'll be programs that benefit certain groups. That's a regime change. I don't know that it'll happen, but to me, it fits many of the pictures that we have seen here on the financial front. As Richard said, I was in retirement from doing media, but I kind of felt that these charts were really important. In 2020, 2021, 22, and 23 I think are going to be some fascinating years from a financial standpoint. If you want to review any of those charts that we published in real time in the oil market from, I think it was about 1999 through 2016, you can find them in chapter 22 of this book. If you want to understand my philosophy of markets, this book will show it to you, The Socionomic Theory of Finance. And that about wraps it up. So regime change or not, that's my view. And unfortunately, it's on the record. So if it turns out wrong, they'll know who to come and find and blame for it.
Fantastic. Bob, can you hear me okay?
I hear you fine.
Okay, great. Well, thank you so much for sharing all that. Don't put those charts away yet. I mean, you've uncovered some incredible long-term structure. That chart of the time in the U.S. stock market back to the Constitution, I've never seen anything like that before. Can we go back and take a look at that for just a minute?
Okay.
This is one of your first charts.
That's the one, right?
Yeah.
Okay.
So first of all, how did you find this?
I've been showing this chart for quite a few years now.
Okay.
And when I originally showed it, I thought 2021 was going to be a major bottom because I had a cycle low in 2022. And I thought, well, they're not perfectly aligned, but they're close. So maybe the market's going to fall into those 2 years. Mm-hmm. But instead, we've been in a mania ever since. And it's gotten so extreme. I mean, they'll be writing about it for decades when it's over, maybe centuries.
Mhm.
Charles McKay will need to have to come back and write a new book
Right.
on the madness of crowds.
This is crowds. How long have you been tracking this chart here?
Well, we've been tracking the data probably since shortly after I started publishing, so it would have been the early 80s. But I didn't really notice all the Fibonacci relationships until maybe 10, 15 years ago.
Got it. Okay. And have you seen this kind of structure in other markets too? This kind of time-based Fibonacci pattern?
I haven't done that kind of work in other markets on a long-term basis because
Mhm.
we don't have data going back that far on any other markets that I know of. But I've seen them on short-term, the short-term in several markets over the years.
Mhm.
But to me, this is the most impressive one. And here's another interesting thing. To me, the number of years per se is irrelevant because what always matters in the Elliott Wave model is the relationship. So between 55 and 89, you have a 0.618 relationship. Between 89 and 144, you have the same thing. 144 to 233, you have the same thing. But you can get it with any different numbers as long as the ratio is correct. But in this case, for whatever reason, it's actually following the Fibonacci sequence numbers. So it's amazing.
It is. I know you gave us one critical point to look for in the CRB commodity index about, breaking that prior low. But, when you're looking at a 270-year time frame or 233 years, 1 or 2 years doesn't really make that big a difference, but makes a lot of difference for us locally here in 2020-21. So
Oh, yeah.
what are you going to be looking for to tell you that this, catastrophe scenario is starting to unfold?
Well, I mean, it's on the record. We'll just have to see. The main thing I think is going to happen in the next 4 years is fantastic volatility and drama. And
Right.
it's going to happen in stocks and commodities and interest rates across the board. And it's certainly going to affect the economy. And there'll probably be tremendous conflict and upheaval in politics as well, and a lot of infighting. So it's just going to be amazing. You can imagine what it was like living in the first half, let's say 1928 and the first half of 1929.
Mhm.
There were no troubles on the horizon. There are always things to worry about, and we have that today, but there's no global wars. Global economy is doing pretty well. COVID kind of smacked it a bit, but overall, things are doing fine. And in just 3 short years, we're in the depths of the greatest depression in the country's history. That's the kind of change I think we're facing. So you have to get ready for that in many, many ways. I wrote a book called Conquer the Crash, which kind of tells people how to prepare for this, which I wasn't going to get into, but
Mhm.
the details are there if you want them. And I don't think it's a frivolous thing. There are a lot of people over the years who have kind of been weirdos because they had, say, stores of dried food and guns in the closet and maybe a fallout shelter and all that sort of thing. I think some of that may be going too far, but you should probably be making some plans for a regime change in the way things work.
And by regime change, it was interesting you were talking about moving from a republic to moving to something that might be more of a pure democracy.
Yeah.
And why did you focus on that?
Well, because I think there's going to be something other than just financial prices that shift in 2021.
Mm-hmm.
You can 29 to 32 is possibly a hint of what might be coming, because immediately after the 1932 low, a whole new philosophy of government was adopted. It was called the New Deal.
Mm-hmm.
Numerous government programs were passed in the 30s and 40s. I think we may be facing something like that today,
Mm-hmm.
and probably of the same sort of ilk.
Mm-hmm.
Collectivist, type programs, government-centered programs, higher taxes, all that sort of stuff. I don't believe those are necessarily going to be the cause of economic change because I think that's natural. It's part of the natural flow of Elliott waves. We're going to get a depression no matter who is in office. And in fact, I was so sure that that was true, regardless of whether the Republicans or Democrats won the presidential election or either house of Congress, that before the election, I said, you should vote for whoever you don't like because they're going to be the next Herbert Hoover.
Interesting. And there's a number of people who are talking about big change. George Friedman is one, Peter Turchin. There's the Fourth Turning guys. Have you been following any of their models, and do they line up with your own?
I haven't followed them, no. I'm in my own world. I mean, I know about these people. I've got their books on my shelf sometimes.
Yep.
But I'm getting a little too old for that. You know that, Richard? Back in my 20s and 30s and even my 40s, I was collecting books and reading them like crazy. I've got thousands of them in my house. I must have 2,000 books on technical analysis and people's predictions and, great depressions of the past, the dark ages, I mean, everything. But you've got to budget your time when you get to be my age. And so I don't have time for that stuff. I just do my own work and that's pretty much it. But I'm always interested. I mean, if anybody wants to tell me about somebody else lining up, that's great.
Out of all your calls, the one you seem most confident in was rising interest rates.
Well, the stocks and interest rates are equal. I mean, I think they're both 90 percenters. Yeah.
Mm-hmm. Okay, they're both. You're equally confident about stocks going down and interest rates going up.
Well, stocks topping this year and then going way down. Yes, and right. Interest rates probably bottomed last year, and are going to go up. Yeah.
With a possible sort of hyperinflation move in commodities, followed by a possible deflationary black.
It's a good question. I'm going to avoid. I did use each of those terms as kind of a descriptive term to show, a runaway commodity market on the upside versus downside. But I'm not going to try to predict those things right now. I've been a deflationist for a long time. In fact, the subhead of Conquer the Crash is how to survive and prosper in a deflationary depression. Now, I think the ultimate outcome will be deflation because I think our credit system is going to collapse ultimately. But whether that happens in the first decline, I don't know. And we already know that the Federal Reserve has been inflating a lot, and our new incoming Treasury Secretary has a philosophy that supports inflation. She's already on record as saying, I think we need to aim at social goals when the Fed inflates. So it's not just a kind of Keynesian stopgap of, we're heading into a recession, let's do some inflation. This is more of a deep philosophical commitment. So I think for the first time, at least since I've been looking at things, and I believe it's been absolutely correct, by the way, to be bearish on commodities for the last 12 years. Well, a lot of people said, QE is going to make commodities explode. I said, that's not how the markets work. They do their own thing, and that's just, that's a red herring. It's trying to take your focus away from the wave structure onto some outside cause. But anyway, for the first time, I would say the charts, at least, are suggesting the possibility of a hyperinflationary scenario. As long as that April load isn't broken, I think that option is in play. It's not my chief outlook because that resolution chart showing a first a big rally and then a big decline, I think feels right to me. Mm-hmm. So I'm not necessarily one of those people calling for hyperinflation. And I've got all sorts of, monetary arguments also for why that is likely the case. But again, that could take another 10 minutes.
Very good. Well, I would like to wrap up with asking you've been involved with the Foundation for the Study of Cycles over the years. I believe you were even a board member at one point. Is that right?
Yes, back in the late 90s.
So we're celebrating our 80th anniversary this year. And we're getting a lot of good traction and a lot of interest from the world in our work, which is really exciting. Where would you hope to see the foundation be for its 100th year anniversary? What can the foundation really contribute to the world?
Well, I think the foundation is restarting at an absolutely great time. because the times when people care about cycles and waves are periods when stock prices are not going straight up. They're either going sideways or down. And that period was, for example, in 1930s and 40s. In fact, the foundation was started by Ed Dewey in the 1940s. It was so popular, the government got behind it and was funding the foundation. So, I mean, that's how popular they were. And then when the bull market resumed, everybody forgot about cycles. Then we got into the bear market of the 70s and cycles were huge again. And the foundation was doing well also. Gertrude Shirk was putting out an issue every couple of months, I think. And then we got into the bull market again in the 80s and 90s, and it's carried on and on through the 2000s up to the present time. And the whole idea of waves and cycles is about as out of favor as you could possibly get. People are completely convinced that authorities are operating the economy like a puppet with strings, and they can, expand it anytime they want. That's what people believe at tops. They believed it in 1928, 29. They believed it in 99, 2000. They definitely believed it in 07, just before the biggest decline since the 30s. And they believe it again today. I think they're going to start embracing cycles. It may be slow, but I think cycles and waves have one more good heyday directly in front of them. So with you at the helm, good days ahead.
I appreciate that. So what you're saying then is that when times get tough, people start to look for some other explanations than, hey, the authorities are in charge and doing a great job. We better look for some bigger patterns here because nobody seems to really be in charge.
They look for alternative explanations to the things they hold dear in bull markets. Number one is authorities are in charge. Number two is everything is mechanical. It's mechanical cause and effect, like a billiard ball being hit on a table. Mechanism is absolutely completely embraced in bull markets and at the top of bull markets. In bear markets, people are looking around. Gee, is the machine broken? What's going on? We thought everything always goes up. What's the problem? So then when people come out and start explaining cycles and waves, they go, oh, that makes sense now. But it never makes sense in a bull market for some reason.
So I take it you don't believe that mechanism is the explanation of everything.
No. In fact, I have a chapter in that socionomics book about a meta-theoretical difference between socionomics and economics. And economics is fine. It has its place. I mean, there are things that can change economics, but social mood is something that's internally regulated. There are no billiard ball effects in social mood, and social mood is what's behind the waves that we see on this chart here. People become more optimistic, they bid up prices. When they become pessimistic, they bid them down. And that is not a mechanical system. That's an internally regulated natural system that is impervious to outside forces. In fact, I think it's the explanation for most things that people think are outside forces.
I personally agree. And I think that's one of the things that the foundation, Edward Dewey called it cycles, the mysterious forces that trigger events, whether they trigger events or not. There is something, there's a mystery to be solved, right? Because I think that the sort of metaphysics of mechanism, if you will, have become so dominant in our world today and yet, there are things and times when that paradigm breaks down and people start to look for a non-mechanistic explanation. And
Richard,
I agree with you that that's likely a time that we're headed into where there's more of a questioning of the sort of command and control model of society.
Well, you're a rare individual, somebody who's an intellectual and also has that opinion, because I mostly come up against blank stares. But if you go toward the end of the book, and I know you have a copy,
I do.
Economic Theory of Finance, there's a really cool chart in there showing, I think, about 90 years of the dominance of philosophical views of finance in the economy. And they ebb and flow perfectly with the stock market. As long as the stock market's going up, the mechanists are in charge. And whenever it goes down, the waves and cycle people are in charge. And the most recent manifestation of that was in 2007, 8, 9, 10, 11, when the market collapsed, the economy was in recession, and the behavioral economists were suddenly famous. Because they said, oh, no, it's psychology. It's not mechanistic at all. It's psychology. And they had their day in the sun. But every time the market turns back up, people forget it all. And that's what's been the fate of we wave practitioners and cycle practitioners ever since essentially the early 1980s. And we were pretty popular, and then everything went away, and they, no, it's mechanistic again.
All right. Well, Bob, we really appreciate you sharing this work with the foundation. We really appreciate your time. I know it's been very interesting to me. But I just want to encourage everybody to join the Foundation for the Study of Cycles. It's $99 a year to be a member, and you get incredible content like this repeatedly throughout the year, as well as access to our cloud-based cycles analyzer where you can analyze any cycles. And Bob, we would love to have the chance to talk to you again, maybe mid-year or so, and check in on some of how this is all unfolding. I can't say that I hope you're right,
No.
but I really appreciate you sharing these insights and these patterns, remarkable patterns with the foundation.
Well, yeah, my intent is to go back into retirement from doing media, but you never know.
All right. Well, thank you again, and we hope to talk to you again soon. Take care.
Yep, take care.
Bye-bye.